I love doing deals and helping clients out. There's not a better feeling that I get when a client calls me after the fact and the deal is done and said, oh my God, because they understand there's nobody cheering for you to get this deal done, right? You typically are the only one cheering for yourself, but you're also the one that put in the last 10, 15, 20, 30 years into your business to build it to this place to be able to have this unbelievable payday.
Welcome to The Boost, a podcast for home service contractors. We explore leaders and innovators in home services, their personal journeys, thoughts, and experiences with growth, marketing, and succession. We cover the good, the bad, the ugly, and its ultimate impact. Hello, everybody. Welcome to another episode of The Boost. Thanks for listening. And I am Zach Wilson, Chief Marketing Officer of Local. Today we have Brian Cohen, Business Strategist of SF&P Advisors. Mr. Cohen, thank you. Welcome.
Zachary, thank you for having me. Appreciate it. Let's have some fun and talk about a lot of good stuff today.
We'll start off with our pre-conversation about how to cut your hair.
Harry's Blades, baby. I leave them in every hotel room I'm at, by the way.
I didn't know they went retail. I kind of stopped it a long time ago.
I did too. And I was just in West Virginia playing golf last weekend with a bunch of buddies, packed everything up in like clockwork. I leave a little travel shaving cream and my shaver like clockwork in the shower. I've done it everywhere. This is probably the 20th Harry's I bought this year.
If you're holding on to it, how many shaves? Because unlike most, you're shaving your head and not your face.
Yes. I'm going to absolute reverse. A lot. I have a million blades.
How many quality shaves do you get out of a blade, I guess? Is it like 2? Is it 5?
No, my God. No, way more than that. Probably a month or more. Yeah. Shave it every other day for the most part.
Oh, you don't do every day. Okay.
No.
No. Yeah. So you still get 15 shaves.
I think that's probably about right. All of a sudden I'm like, hey, it's time for a blade change.
The funny thing about that is you don't really, and I'm sure this is the case with you don't really realize it until you're like mid-shave and you realize that it's really painful and you're like literally pulling the hairs out of your skin, the follicles. You're like, what am I doing?
Sliced myself this morning because it was a new blade. You got to be careful with the first couple shaves on the new blade. Got to break that puppy in a little bit.
That's why I moved from those. I cut myself a lot with those, and I never ever cut myself with the mock. Never, which is great. I think it has something to do with the blade design. I don't really understand it.
They're sharp. There's a reason why they work for as long as they do. So maybe that's a German engineered.
Maybe that's what it is. So we are the formidable experts in razors and shaving, but we're actually here to talk about money.
The fun stuff.
Businesses and deal making and the state of them in maybe 2025. So let's just start off with introducing yourself. I obviously know who you are, but maybe everybody else doesn't. Brian, what do you do at F&P and what does F&P do?
Great question. So SF&P Advisors, we're a CPA firm and we represent sellers in their transactions with private equity. Our main clients are the home service space, HVAC, plumbing, mechanical, industrial contractors, garage doors, roofers, anything that's going to be home service related.
Marketing agencies.
When I say anything in and around that space, we handle plenty of those transactions as well. It has been incredibly exciting. I was lucky enough to get in the space called end of 2016, beginning of 2017. So the quick backstory is the owner of the company, our president and CEO is Fred Silverstein. Fred's been one of my best friends since I moved to Florida, and I moved here when I was 14. So he's one of the first guys I met. We lived a block away from each other, and shortly thereafter became very good friends. Fast forward 30 some odd years later, here we are working together. Our moms know each other. It's pretty integrated.
That's really cool. That's awesome.
It is. We love each other. We hate each other. We scream, yell, fight, the whole thing. But at the end of the day, friendship based on decades. I was actually going to be up in Boca Raton looking at an opportunity. I was doing sales and marketing consulting with a number of clients. Not lighting the world on fire because I had, imagine this, business owners didn't want to listen to the advice that I was giving. I was beating my head against the wall, and some of these guys were implementing things I was talking about 6 months later saying, wow, this is genius. I said, well, let's look back to the notes. We talked about this 6 months ago. Long story short, I was going to look at another company to start working with up in Boca and had a chance meeting with Fred and his wife, Grace. And I think at that time they were wrapping up Dave Geiger's deal or pretty far down the path with the Horizon Services deal. So this is now end of 2016, beginning of 2017. At that particular point in time, one guy doing business development, not really being ultra successful with it. Another buddy of his that was helping out with some financial modeling, and the brunt of the work was falling onto Fred's shoulders. So he said, listen, I know you're amazing at sales and marketing. Do you think you could go find us clients? Sat back, we had some conversations back and forth, and we put a little agreement together just to get a feel of what this would look like over the next 3 months. Let's see if we can work together. Let's see what this looks like. Because this is not always easy working with friends, right? But but I liked what he had going on. And at the same time, I know Fred, I know very well. There's no BS. And he's a CPA. 1+1 is equal to, cut and dry how this is going to work. And on top of it all, he had a really big opportunity, really big deal that he had just closed, which for me was a springboard marketing wise, right? I had probably one of the best known companies in the country and best known owners, Dave Geiger and his partner, which I think was Mark Aiken, if I'm remembering it correctly. And everybody knew those guys. So it got easy to have conversations and said, hey, we just finished this transaction. You start throwing that name around a little bit and people want to have some conversations with you. So I think we'll call it in that first couple month trial period just to see what we could do. I had signed on 3 clients. One of them was a very, very large process piping company in Indiana. And we were kind of off to the races at that point in time, getting Fred in front of people to be able to have these conversations. And I learned the business very quickly. I took on a life of my own. The business started to grow. He was doing 3 to 5 deals a year. Now it was 7. Now it was 12. My pipeline kept growing. And then you walk into COVID. All of a sudden, the world stopped. We had a bunch of deals in market. They stopped. Everything stopped. He said, oh my God, what's going to go on here? And I've told this story before. I'm always talking to 50, 60, 70 different owners. So we gave everybody a 2-week reprieve. And then I started having some conversations. These guys are like, man, my phone's ringing off the hook. I can't hire enough people. It's nonstop for us right now because now everybody's at home, right? They're running their HVAC system 24/7 instead of 10 hours a day or whatever the number of hours a day they were home for. And plumbing issues, right? Everything's being used 2, 3, 4 times as much as it was from before. So you're going to start to have some issues. I get invited into a private equity symposium. Couple hundred people on a Zoom. Hey, Brian, give us the State of the Union for private equity in the home service space. And I said to these guys, you're going to pay more for these businesses. I said, there's not going to be anybody for sale the way you think it is. And I get 20, 30 calls from these PE guys afterwards ripping me. Oh, you're out of your mind. These guys are going to go down. They're going to need money. I said, I think you're going to pay a lot more. And lo and behold, they started paying a lot more because these guys were now pumping out that revenue differently than they had from before, right? Manufacturers had all kinds of deals going, 0% interest, a lot of low-hanging fruit. Everybody's at home. No one knows how long they're going to be home for. In addition to that, private equity is looking for spaces to invest in. And all of these new buyers flooded the market. So this was 2020. End of 2020 got very busy. 2021, I think we did almost 50 transactions that year.
I don't want to get too into this because I feel like everybody kind of knows this. But at that point, who was pushing the contractors, business owners to the table? Was it just the money or was it COVID, or what was the real impetus of more people coming to the table during COVID to sell?
Great question. So years prior, it was 5x multiple, 5 to 7x multiple. That's where you're at. And now you're talking about 10. The old saying was, in order to get 10x multiple, you need to be 10 million of EBITDA, right? We're now getting deals done at 10x multiples with $1.5 million in EBITDA, $1.6 million in EBITDA. That's huge. You've got this once in a lifetime thing that just happened that's spiking everybody's revenues and EBITDA number. How long do you think this run is going to go for? You realize eventually things are going to get sorted out. People are going to go back to work. And I don't want to say things are ever going to normalize or go back to where it was. I'm working out of my house still. You're working out of yours too. So for me, I actually enjoy working out of my house. I'm a lot more productive. But a lot of other businesses, they started going back to work and things started to shift the other way. So you needed to take advantage of it while it was there. You've got a feeding frenzy of all these buyers that have entered the space. All of these companies are getting marketed to and promoted to by these PE companies wanting to do deals. If you haven't called me to get an idea what your business is worth, shame on you, because you need to get multiple offers to know exactly where you're at. So there was a lot of very smart owners as well. Dave Geiger was one of them. Ken Goodrich's deal was done shortly after that. Travis and Tyler Ringy. You think of some of these smarter people in the space that were getting these deals done. They realized we want the best representation. We want them to bring to us as many offers as possible so we can play one against the other and get the best outcome for ourselves. Now you're past that, and there's owners out there with the same mindset, which is, hey, I want this crazy multiple. That ship has sailed. The 10x guy's not getting 10x now. The 10x from 21 and 22 didn't get it in 23, and they're not going to get it in 24. Now, does that mean that's across the board? No. But you also had a lot of premier assets that got deals done. You look at our laundry list of deals that we got done. My God, Wyatt Hepworth, Ray Isaac, Ross up in Jersey, Ishmael was another one. I mean, these are really big players with some really good assets that they were getting done during this period of time. So now you're on the backside of it. Kenny Haynes said something really neat at this Service Titan private equity event that we were at in New York a couple weeks ago. And he's like, okay, the pond repopulates. You're right. A lot of the biggest players got picked off. There's still a handful of them, obviously, obviously, that are still around and holding out. But does that mean that they're not going to get that premier multiple from a couple of years ago? No, I think they probably could. It may take a little bit more work. I think they could. What I will say is this: interest rates have gone up. Private equity borrows part of the cash in order to be able to get these deals done. So interest rates have gone up. So they can't necessarily pay the same thing they could from before because service the debt is a little bit more expensive than it was previously. In addition, they are really diving in differently on due diligence. They're really vetting out these assets because there's a couple of these PE companies that are crapping out. They're not getting to where they need to go. Maybe they overpaid for the asset and servicing the debt got a lot more expensive. Quote unquote, 2023 was a down year, which by the way, it was not. It was a down year compared to 2022 and 2021. Yeah, I don't even know how you factor that in, but when you go back to the last normal year, 2019, it was actually up, somewhere between about 4 and 10%. But you can't really factor those other years.
That's a good call out. Between 2019, if you just go from 2019 to 2023 year over year comparables, as opposed to the ramp up, you're up, what'd you say, 4 or 5%?
Like 4 or 5, somewhere between 4 and 10%, we'll call. So you have these people that said, oh my God, we're down. So imagine, we've got deals going to market in 2023 and their quote unquote numbers are down 15, 20% or whatever it was. So it's hard for private equity to bid at the top end of the valuation range where they have an asset that's perceived to have gone down. They lost pace over that year. So they can't offer top end of the range multiple. So a lot of deals that we had at market unfortunately stalled. Okay, they pushed off into this year. Okay, things flatten out. I'm going to say normalized a little bit this year. We've gotten some really good transactions done. Pretty much it can be a pretty big year. And then last quarter is going to be crazy election time, right? Everyone's going to get nuts. Deals will slow down. And then I think we should kind of be back to normal in 2025.
Take away an election year, take away COVID, all things being normal. So I guess 2023, 2019, 2018, what are the most active quarters for transactions?
They're all active. Deals you got done in the first quarter, ones that carried over from the year prior. Then you get into the second quarter, which, are stuff that may have started that just continue on. I would say that third and fourth quarter get very active. Listen, if you're an HVAC business, when do your numbers spike? Your numbers are going to spike in the summer. So you want to be able to take advantage of all of that revenue and potentially EBITDA that you can add on. Deals are done, by the way. Let's take it back. Deals are done on what's called trailing 12 months. So we are now in May, beginning of June. So if I'm doing a deal, it's going to be on my numbers from this May back until last June of 2023 through May of 2024. That is what my trailing 12 months of EBITDA is being determined by. So if I'm moving this forward and I take a look back to where my numbers were last year, June, July, and August of 2023, and maybe last year wasn't a great summer. I remember talking to folks in Jersey and it was 65 degrees in the middle of June. So if it's going to get hot out this year and get busy, you see an easy comp over. There's a game within the game. You could spike your EBITDA, right, running through this summer if you get a good summer. And these are some of the things that are lost on some of these owners. They get a phone call from a private equity guy that offers them some number that sounds amazing to them because they just don't know any better. And here they are trying to get a deal done, not realizing that, man, these are sophisticated transactions. You should have a professional handling your transaction who knows how to speak private equities, and you just continue to go ahead and run your business. And there's got to be some trust there. So I like to think when I take a look at what we've gotten accomplished at SF&P and the deals we've gotten done, and the platforms that we have created through sales, and the respect that we have from the private equity community because we bring good deals to market and do so much work behind the scenes, there's a reason why we get our clients top end of the multiple range time and time again. We know who the buyers are. We know what they're looking for from a business mix, from a geography standpoint. And the owners, by the way, are becoming more educated. Let me not beat on everybody, but you're talking about an asset that you get one opportunity to make the best transaction happen in your life. I don't know how you leave that to chance. And any business owner that's trying to handle this on their own, I think they're leaving it to chance because they just don't know how the game's played.
Looking back at just the first 5 months of the year, what's causing things to stall right now? Is it the buy side or the sell side?
I'm not seeing any stalling. So let me take one step back and I'll take a step forward, right? I love doing deals and helping clients out. There's not a better feeling that I get when a client calls me after the fact and the deal is done and said, oh my God, because they understand there's nobody cheering for you to get this deal done, right? You typically are the only one cheering for yourself, but you're also the one that put in the last 10, 15, 20, 30 years into your business to build it to this place to be able to have this unbelievable payday. I am signing an absolute ton of new clients, whether we get the deal done this year or next year. I got to know where their numbers are at. Oftentimes we're working with clients for a period of time in order to be able to get them to where they want to go. There's never a rush to get a deal done. It only works best when it works best on the time frame of the owner. So one of the biggest questions I ask these owners is this: here's the rough valuation of your business. Is this getting you to your definition of your promised land? Do you have enough other things coming in, passive income, whatever ones are being investments, that with this chunk on top of it, you get to wherever you want to go? Or is this buying you time? And what does a partnership look like with private equity? You're going to have an equity role, which gives you the potential second payday or second bite of the apple. Let's talk through what all that looks like and let's frame it out to see how it works for you. Every one of these deals has its own fingerprint. Listen, your goals are different than somebody else's goals. So let's make sure when we put these deals together that we make sure we get your goals accomplished. That's the most important thing. And I think it's a reason why we get the reviews that we get. We listen to what our clients are saying. We listen to what's important to them. There are so many parts of this deal that get negotiated and done. It's not just about the number. It's a non-compete. It's potential equity for your employees. It's all of these things, employment agreement. There's so much that goes into it. There's sophisticated transactions and you're talking about big numbers. And I think we get lost in it. We kind of become desensitized towards it because everybody's deals $100 million. They're not.
Do your best on this question. So let's take 4 buckets, 0 to 10 million, 10 to 50 million, 50 to 100 and 100 plus. So we'll start at the top because that's probably the easiest. Of 100 deals, the number of deals over 100 million are what?
Handful.
Okay. So 5, less than 5. That's a big number. I was going to guess 1 or 2. Okay. So we'll just say 5%. So then going down 50 to 100 million.
Probably another handful and a half, 2 handfuls.
Okay.
You have to realize it's very hard to get to that number.
That's why I'm doing this exercise. Now we're at 15%, 5%, 100 plus, 10%, 50 to 100. Now 10 to 50. Now keeping track here, we've got 85% less.
Plenty, probably another 50, 60%, somewhere in that range, maybe 70%. I would say the balance probably is 10 million and less.
The majority of deals that you guys do are between 10 to 50 million, which is a big gap. I was reading something, it was an interview with you from Home Pros who had said something about it. And it was, you get to that 20, 30 million mark as an owner, and then you can get stuck, whether it's addressable market, whether it's capital, whether it's hiring. I mean, there can be a lot of friction that comes up at that point. And to your point in this article, that's when you can extend the olive branch and say, hey, I've done this. I've been stuck here for 10, 15, whatever number of years, and I can't get over the hump. So I need some help.
Hey, I've got my business to 30 million bucks on my blood, sweat, and tears, and the blood, sweat, and tears of my team as well. Where do we go from here? I don't know how to get to 50 million, and I don't know how to figure out a way to get my people compensated up for the growth that we've had. You partner with private equity. Again, every deal is different, right? And every private equity partner does things a little bit differently. But when I'm sitting down with a client, we're having conversations with a lot of these potential buyers. We want to see how our client how well they're going to play in the sandbox with their potential partner, the buyer. I use buyer and partner kind of interchangeably, and what that looks like. You have to have enough of those conversations because you have an agenda, they have an agenda. I'm the business owner. What's my agenda? How are you going to help me grow? What are you going to bring in differently, right? All right, you're going to give me economies of scale. You're going to get better pricing. You're going to get some back office synergies. What else can you help me with? So on that spectrum of buyers, on one end, you've got I call it the 3 guys in the ivory tower. They just have a lot of money. It's an EBITDA game. I want to buy companies A, B, C, D, and E. You guys report your financials. We'll do as best as we can to streamline in the background, but we want to flip this pretty quickly. This is a business to us. We want to buy it, see what we can do, flip it. We don't have a ton of support for you. You're going to keep running your business, but that's why we bought you, is because you were a good owner. But we just figured if I've got 3 million of EBITDA times 4 of you, I've got 12 million of EBITDA or 15 or 20 to be able to run the market with. Put this all together to sell it. We'll all go make some money out of this. By the way, not a bad play. They're laissez-faire. They're going to keep their hands off. Just report to them and have your meetings a couple times a month. May or may not provide a lot of support. On the other end of the spectrum, there's some of these private equity guys that are almost like strategic partners. They know your business intimately well. And when you do a deal with them, you're budgeting out. You're saying, hey, I need 4 trucks for next quarter. Great. Here's the 800 number. Go get your trucks ordered. I need employees. Great. Here's the hiring line. Let's go help you market to go get people. Here's marketing. And you're part of almost like the next level of an affinity/coaching group. They're there to help you differently. There's no right or wrong answer. Sometimes the people on one side are going to pay a whole lot more than the people on the other side. So what ultimately is most important to you in getting your transaction done? Plus, you get to a certain size, people want to get taken care of that have helped you all along the way. So how are you going to take care of these people? Eventually you have to do a deal because you want to get some stock in their hands. They're now part of this and they're going to keep rowing forward for another couple of years. And the hope is when that flip happens, they've got some stock. They get taken care of very significantly too.
What's your point of view on, or your general recommendation? And it probably is it depends. Who should roll over? Who should take equity in, the platform, and who shouldn't? can we just draw a line in the sand and say it depends on age? If you're 35, roll the dice and take some equity and run with it. And if you're above 65, just, get your full cash out and go to the beach.
Great. And I'm sorry to say it depends, but let's look at these couple scenarios, right? So let's say I have a business owner that's in his 60s that's been at the business for quite some time. Business has a valuation, say somewhere between 5 and 7 million. The question is, does that owner want to stay on for the next couple of years to keep grinding at the business, to grow it in conjunction with his partner? So eventually, when the flip happens, he gets paid again. Or does he just want to cash out and say, you know what, I got it to this point, partner with my management team, I'm out. I'm going to take my money and out, and you partner with my management team, and let's make sure they have some stock. What works best for you? Some guys don't want to do it anymore. With the younger guys, I think what got interesting, we say younger guys, we'll talk about guys under 40 years old, right, to make it easy. They have the energy that says, man, if this world goes to hell in a handbasket, I know how to do this business. I can go do it again if I have to. These guys got paid very handsomely. They had the opportunity to roll equity. If they trust in their partner where they're going, there could be one hell of a second payday, right? And they're young enough with the time horizon in front of them. When you start to look at, these guys are sophisticated and smart. These are no dummies. And you're talking about FU money in a lot of these situations. I've said this before. There's this number that gets thrown around that says when you have a net worth of 25 million, you can too much do anything. You may not be buying a $100 million yacht or buying a plane, but you can rent a plane and travel. You can hop on a yacht for a couple of weeks and cruise around if that's what you want to do. You don't need the carrying costs of it. And you can rent houses all over the place. You don't necessarily have to have second homes. Like you could live top percentage, 1/10 of 1% type of lifestyle. So when you start hearing that these guys are getting these deals done for 35, 40, 50, 60, 70, 80 million dollars, it's holy shit. It's never happening before. And kudos to Fred. He started getting involved with private equity, years and years ago. And by the way, there weren't that many buyers. I think that's what gets lost, is that everybody thinks that this is so easy. It wasn't, man. Listen, we had a private equity list. I was on the phone night and day calling these private equity companies to get them interested in taking a look at some of these deals. And then all of a sudden, some more started coming in, more people. We bring a deal to market. We were having 50, 60, 70 potential buyers signing non-disclosure agreements to take a look at deals. That's a lot. Now, has it dropped off? Sure, it has. Because some people, they took a look at the NDA, they took a look at the teaser, or we have a quick conversation. Like, everybody wants a premier asset. The game has changed a little bit. You want to put your best foot forward, and these businesses, they need to be good. They're not buying just to buy. It's not like this housing market where the bubble, oh my God, everybody's going crazy. Everybody's talking about real estate investing. That's changed, right? There's more buyers in the space. These buyers have investment committees that they have to answer to differently now than they did from before. Sat there at these PE summits and you listen to how these guys buy and what they're looking for. And some people sit back and they're not going to do it unless there's a value play for them. And there's other ones that understand I can run with this asset and make it even bigger. And, we're trying to blow up this portfolio. I think the bigger question that needs to get asked is, okay, so you've got all these platforms out there, some large, some small. Where do they go from here?
I am so glad I found somebody else that asked that question, because I feel like I'm the only one that asks that question. What is the next play for them? Roll them and try and go public? Like, that is just not going to work. I just don't see that happening.
Not to agree or disagree, but just to give you some history. People used to say this about the private equity space, right? When Blue Dot blew up in the late 90s, early 2000s. PE will never come to the space and make things happen. They just don't understand it.
Educate us.
So Blue Dot was a consolidator in the late 90s, and they were buying assets all over the place. In hindsight, like, there were some mistakes that were made. They would buy up a company, they changed the name over to Blue Dot. Well, why would you change ABC HVAC that's been in this town for 30, 40, 50 years? Okay. Now you change it to Blue Dot. People don't know who they are. So they try to reverse them, change the names back. Then they were buying, there was a little bit of a buying frenzy. It wasn't like there were that many buyers. We got to get this deal done. Well, this is a 50-50 commercial residential. What's your thesis? What are you looking to buy? They were just buying to buy, right? People made money, then they were able to buy their businesses back for 10, 15, 20 cents on the dollar and do it all over again. Private equity got smarter. Some of the people crapped out and they're out of the way. More people came into the space, another level of sophistication. And there's been a lot of really successful deals that have happened. A lot of successful second, third. Some of these guys are going to the third bite of the apple now. So there's been some success there, more sophisticated. They've also gotten bigger. So you start to say, okay, who's buying up some of these next level guys? Listen, there's funds in Europe that are billions upon billions of dollars that are sniffing around this space to be able to make some monstrous acquisitions, right? There's also the play of a couple of these guys coming together and somebody going to market. I think that's very viable. Whatever that next step is going to happen, that rising tide is going to lift all boats. That's just going to be another opportunity for everybody to capitalize financially on what's going on. Going to market is expensive. It ain't cheap. I don't think people understand that. I think they think, hey, we just do an IPO and away we go.
Right.
Not even close. At the same time, listen, there's some of these PE plays, they're going to keep running these businesses and growing them. They're cash flowing them. Well, that's
Right,
another play
right,
too. Not
right,
everybody has to pick these up and go ahead and flip them and do
right.
something with them. If they're run well, they can cash flow for a very, very long period of time. So there's a ton of interest. It is an essential service. People can't go without this. As much as we try and reinvent the wheel, there's sophisticated things. You got service statements come into play. You've got Billy Stevens with Sarah. You've got Blue On coming in and bringing something to the table. Smart AC has brought something to the table. Like all these things. And these guys are growing on their business models. They're getting a fence put around the client. These guys have become successful with HVAC, bring plumbing in, and plumbing brings electric in. And that moves into, hey, there's a roofing model out there, and hey, there's a pest control model out there, and a lawn care service and a pool service. Like, why can't we monetize all of these things? And those light bulbs started going off for probably the last 5-6 years. That brought another level of excitement into this. There's so many ways to be able to monetize when you get into a home. The point of this is there's still so much upside, man. Do you realize there's like 3,500 licensed HVAC contractors, I think, in Phoenix and Scottsdale? Realize how many deals have been done? 1%? Probably less than 1%. So everybody talks about consolidation. I don't know, maybe less than 10% of the market still. There's still the ability for these things to happen. But I think where it gets interesting is, Freddie talks about this often, when you take a look at a marketplace, there's a triangle of businesses there, right? You've got your top echelon guys, you've got your middle guys, and you've got your smaller guys. And your smaller guys, a couple handful of guys, they don't have big overhead. Your top guys are running at such efficiencies, or we'd like to believe they are, and such economies of scale, good for them too. Where things get interesting is that middle market, right? 5 to 10 million on the lower end, maybe up to 20, 25, 30 in the middle. Again, if I'm one of those business owners and I see what's happening in my market and I'm losing opportunities to these guys that are smaller than me because they did a deal with private equity and their economies of scale are so much different, and they're getting this crazy reduction in equipment costs and all these back office synergies, why am I not looking to do this deal? Because when this passes, if the multiples drop off again, I'm going to want to hang myself. Can you really ever get hurt making a deal happen and getting that money? If you think the market is going down with whatever election and going into next year, then everything's going to be on sale next year. And if the market goes up, what's your hedge? Your hedge is you did your deal. You've got an equity roll in with your private equity partner, and you're going to get paid on your equity roll. The only way that you get hurt, and where people, I think, fail to realize this, is you're going to continue to pump and grind and bump and grind with your business. Man, if you hit one snag and or hiccup, some of these things are tough to recover when you're a bigger company. It's nice, partner with private equity, get your personal guarantees out of the way all over the place. Let them sweat it out with what's happening with the business. You're operating the business. Imagine what it's like to mentally shut down at 4 or 5 o'clock every day, when most of these guys have not done this in forever. I'm going to go off on a tangent here because I think you'll appreciate this. I have conversations with my clients. I keep in touch with these guys, right? You see me, I'm playing golf with them. We're hanging out, we're doing our thing. The majority of my clients, become my friends. I like these guys because you find out what their story is. You meet their families. It's like, holy shit, I can't believe, like, the balls it takes to be able to grow one of these businesses and strike out on your own to do something is so next level. I have all the respect in the world for these business owners in this space. But their deal gets done. It's a year after or a year and a half after. And I just had this conversation with a couple of these guys, and their businesses grow by 40%. And they're like, holy shit. Like, I didn't realize this was possible with this business, right? I don't think I could have gotten there without the help, but man, they came in. Imagine being able to make decisions as a business owner without worrying about your checkbook, say without worrying whether it's going to succeed or fail, but having the backer behind you saying, we like that idea, let's get after that. All your equipment costs drop. You need employees, no big deal. You're not putting a ton of effort now. Your back is covered all over the place. Your HR, stuff that drives these guys nuts, that gets taken off your plate. And you're able to focus on the parts of your business that you are the absolute best at. The sky's the limit on what can happen. You look at these partnerships, right? Oftentimes you don't have partners with the same personalities, right? Like, I look at Freddie and I, for example. Man, Freddie's a CPA. Freddie speaks CPA, right? I'm a sales and marketing guy. We're two different people. But man, the synergy that happens between the two of us is next level. And I see this in a lot of these business partnerships where one guy's great here, one guy's great here. They stay in their lanes and they know what they're doing. Man, the things that can happen is incredible. Well, when you can find that right partnership with your private equity partner, the same thing.
Let's go back. Who you partner with and who's in the marketplace on the partner side. So there aren't that many of them, but there's a lot of private equity, right? But there aren't many businesses that are quote unquote private. The one that I always use example of is Hoffman Brothers, the Deutschman Lane Holdings. They've only done a couple deals, so that's probably not a good example, but they're really big. Do you work with anyone that has this long-term vision or that has a shared vision like they do that's that's
Sure.
buy and hold on for dear life. I'm digging into the nuance of what's said here, and everybody says private equity. And for those that don't, pay attention to the nuance or don't understand the nuance of private equity versus Deutschman Lane holdings are very, very, very different businesses and very different models, right? Private equity, I'll let you explain it. You're the expert here. Private equity is what? Their strategy is to what? And their objective is to what?
They want to be out in 3 years. I rough it at 3 years, right? That's where their IRR, internal rate of return, is the highest. Does that mean that they won't go over? Sure, sometimes they go over. And does that mean they won't go early? No, sometimes they'll go early too. But let's use it as a 3-year benchmark. It is a buy it. I got to get my investors a return. If I'm your strategic private equity partner that understands these businesses inside and out, I want everybody operating on the same systems. Everybody's accounting looks the same. Marketing, we're budgeted out. Everything is done because we're trying to maximize the efficiency of all of the assets that we have, get them all moving in the same direction. Let's push that EBITDA as far as we can because we're going to get paid on a multiple of EBITDA. Boom, pretty simple. Not that I'm saying everybody's not trying to do it. They're just trying to do it through a different level of sophistication. Then there's the buy and hold. And they are in no rush to sell because they want to cash flow these businesses. Okay, when you understand if you're going to do a deal with one of those guys, chances are they're going to want to buy you out potentially altogether as the owner because there's really the second bite of the apple may not happen for 7 to 10
Ever.
years.
Yeah, or ever, right? Well, it's important to point out that at that point it becomes really an annuity, right? Because you're just getting distributions or you're getting a bonuses
bonus
or
down, whatever the back way looks like. And I'm not saying that there's anything wrong with that, right? But they're looking,
no.
But a buy and hold is looking for a different type of asset than somebody who's looking to let's pick it up, let's move it and build it and flip it. Just different assets. And if you want to take it a step further, there's companies out there that like the leasing model, which is incredibly popular in Canada. That hasn't gained the traction necessary here in the United States. But man, when you take a look at those numbers, that leasing model is pretty incredible. The numbers. I'm not saying anything else about it is incredible. Can't tell you it's an easy sale, hard sale, whatever it is. I've just seen the numbers. And I think at the 6-year mark, your EBITDA goes absolutely nuts year after year after year because you got these people that have passed over a certain threshold and it just keeps dropping down to the bottom line. You tell me where things are going to be in 6 years. If you would have said in 2015, holy shit, in 6 years from now, it's going to be the craziest market ever in the HVAC space. I don't know. My crystal ball, only goes out about 6 months at a time.
Yeah, right.
I can't tell you. I think generally speaking, it's been an incredible run of the last couple of years. We had something that stared us in the face that hurt a lot of us, but for those that were able to stick it out and keep grinding, it was one of the most incredible things that ever happened to our space. Put us on the face of everything. HVAC and plumbing, home services became front and center. More investors, buyers came into our space than ever before. Some of the most incredible deals that have ever been done in our space happened during this time period. Now, here's where it gets interesting. We're maybe one step off of that. Maybe one step off of that. The guy that was getting 10x in 2021, 2022, maybe getting 9x now.
8, 9,
right. It's not like you're talking like this thing has fallen apart. That's why it's easier I shave my head instead of pulling my hair out. I have a conversation with owners and I'm just going to wait for it to come back. It was never there before. Remember when it dropped off and came back to the 10x before? Because it never happened. You have to be careful, right? Pigs get slaughtered. Dave Geiger said it best. Dave Geiger, it was more important that he had the right partner. Do you realize this guy never timed the market? It is one of the flagship deals ever in the HVAC space. And he's on his third bite of the apple. His first deal was done, called second quarter 2017. His private equity partner, Sun Capital, flipped the portfolio fourth quarter 2019. He's on with his second partner. And whenever his flip's going to happen, it's potential this guy could be one of the first $1 billion owners in our space. And he never timed the high or the low of the market. He just found the right partner, So people get caught up in this sometimes too. It's a little nutty. You're one step off from where things used to be. The sky hasn't fallen. And by the way, 2023 wasn't even a great year. And I'm still telling you, we're only about one step off.
A couple things to just dive in on and clarify. So law of averages, if you're going to partner with one of these private hold on forever type of companies, I don't really know what you call them.
Call them buy and hold. How's that?
Buy and hold. Yeah. Not private equity. I'll have to ask Chris Hoffman what he calls himself, but he says on their website, I'm pulling this off the website, he uses the word direct investing. So maybe that's what it is. I actually don't know. I'll have to ask him. They're looking to, as you detailed, acquire most likely 100%, maybe leave you with a little bit. So on the private equity side, what is the minimum amount that you can expect them to take? 51?
Well, there's majority deals, which a bulk
Right.
of them are.
So let's
PE
talk
does
about
not.
the majority deals first.
The bulk of them are majority deals. So I got a business that has an enterprise value of 10 million. My offers come in, we sign off on 10 million. They want me to reinvest a portion of that back with them. Typically it's 20%. Now I'm going to get 8 million at closing. 2 million of the remaining 10 is going to get transferred over.
They're taking 80%.
Well, they're buying 80%.
What's the minimum in a majority? 51%?
No,
No one will even go that low, right?
No,
60?
because remember, they believe in themselves and they got to get a return for their investors. So they
Right.
love the fact that you as an owner want to put more in than 20%. We negotiated those deals. We have negotiated more and less, right? We've negotiated guys down to 10%. We've negotiated guys probably somewhere in the 30% range. Every deal is different. You know, what the business owner thinks is going to happen with the portfolio and how much they want to put back in. But as the buyer, as the private equity group, I only want them putting in so much.
What's the lowest that you guys have done? 60, 70? Give me a number.
Yeah. Sure, somewhere in that neck of the woods, probably they bought 70% of the business.
70 would be the lowest you guys have seen.
Well, we'll say they gave them 70% of the value of the business, allowed them to reinvest the other 30. They were going to convert that into stock into the portfolio. 10 to 30, 10 to 35, we're somewhere in that spread. But remember, sometimes these buyers, listen, if you want pushback, that they don't want you to be able to put that much in because they believe anything they're giving you that you're able to buy in is less than they have. And so when the flip happens, right, buyers want the owner, this happens all the time, to be reinvested back in. It shows belief in what's going on. That's the bottom line. And they want to make sure the owner's tied to the business.
Do you guys do any minority deals or no?
Sure. Very rare.
Very rare.
Yeah, because it's hard for a private equity guy to come up with money for investor money and say, hey, by the way, the business owner over here is going to call the shots. We're in the passenger seat, not in the driver's seat.
Right. It just doesn't make any sense. They want to bring some expertise and some efficiencies to the table. And if you're going to do that, you need to put more into it.
It could, if you're big enough and you're looking for money to be able to go out and continue to make acquisitions. That kind of seems to make sense. They're one-off scenarios at best, right? The majority of the deals we do, they're buying out the majority of the business. Then the next bulk of deals that we do, they're buying out the business altogether. And then the last little tranche is, hey, it's a minority situation. They're just rare.
In your prospecting, let's just talk about, or in your pipeline, if you will, what's the first step for a seller to get engaged with you guys, SF&P, as a first step?
Call me, text me. It happens all the time. I'm at 954-226-3409.
Numbers you want to see. If I'm talking to Brian, I just texted you, have a conversation. You're going to ask me for, what do you want to see?
P&L, some balance sheet items, a couple of years of some tax returns, just so we can get a bird's eye view of what's going on with the business.
Just to basically dot your I's and cross your T's. Yes, you're not full of shit.
There's steps to find out where the full of shit comes in at. But for the first one, to give you an idea where things are at, pretty simple, right? We have some conversations on a call with our team after we get the financials in, ask a couple questions, and really say, hey, here's the range. You're 8 to 10, you're 12 to 15, you're 18 to 20, 7, wherever that range is.
What are we talking about? Top line?
No, range of valuation for the business. There's a ton of factors that go into it, right? How big is the business? What's the business mix? What part of the world is the business in? What's the management team look like? How long have you had the business for, right? There's all these different factors that add into it. There's nothing bad. Somebody says, hey, I don't have a lot of reviews. Okay, well, there's an opportunity for your partner to come in and go beef up your reviews. Like, there's nothing that's really wrong. We just have to kind of know what's going on with the business to be able to frame it properly.
Well, I was going to ask that question. There's got to be. What is the scenario where you get your first, piece of due diligence and you just say, can't touch this?
Too small. The smaller deals that we do, keep it from a revenue perspective, these guys are between like 3 and 5 million in revenue. And those are tougher to do, not as many buyers. But if you're in a good location, we can make something happen. Part of the challenge is your guys sub 5 million have this expectation of a 10x on an EBITDA, right? So when I'm talking to guys who's $3.5 million in revenue, and his EBITDA number is, say 400 grand or 500 grand, you're not getting 5 million for the business, but that's what he wants. Well, he's got to grow it. So the challenge therein lies, how long have you had the business for? If you've had the business for 20 to 30 years, you're still doing 3.5 million. I don't know how to tell you to get the 5 million. This should have been figured out decades ago.
15 years ago. Right.
Yeah, years ago. So you're not going to get that number. And the fact that you haven't grown can get looked at from two different perspectives for private equity. Perspective one is, this guy doesn't know what the hell he's doing. He's not going to be able to grow it, right? I got to buy him out altogether so I can go run the business. Or scenario number two is, bing, bing, bing. This is a company that's going to be on sale. It's discount. I'm going to give them a nice multiple, right? Whatever the multiple is on a $3.5 million business, knowing that I'm going to come in, I'll keep the owner in place. I'm going to start showing them what to do to go from 3.5 to 5, 5 to 6, and 6 to 7.
So let's give everybody out there a little like truth serum on this is if your top line revenue 3.5 million, your EBITDA 400,000, let's just say for argument's sake, what's a realistic number
4 to
from
6x,
an EBITDA?
4 to 6
Right,
times
right,
that.
right, right, right.
So you're
That's
talking, let's take the midpoint at 5, it's $2 million.
let's just be real. If you're 70 years old and you've been doing this for 30 years and you can
Sail up into the
sell it
sunset,
all for
whatever you're.
$2 million, that's not chump change. I want to make that crystal clear. And most of these people, which I think is an oversought piece of the equation for small businesses and small business owners, I hate putting labels on things like this, but generally not as disciplined and not as structured as mid-market and large businesses, right? And therefore, they haven't been disciplined with retirement. They haven't been disciplined with 401k. They haven't been disciplined with, maybe their SEP or whatever retirement vehicle that you should have in place. And therefore, they probably don't have anything from a retirement standpoint. All they have is their annual salary. So walking away, stepping aside and saying, okay, I've capped out, I'm throwing in the towel, and here I am at 70 years old, 60 years old, 65, and I can get 2 million bucks. Do it. Like, your business is still worth something to somebody. It's really important, I think, to say that. And this is
Agreed.
why I asked the question earlier in terms of bracketing, in terms of the deal size, because almost every business is worth something to somebody. And the businesses, as you pointed out, they're 3,500 registered HVAC owners in Phoenix, Scottsdale. All of those are not going to have $10 million paydays. They're just not. A lot of those are going to fail. So if you're one of the ones that reaches 50 million, great. But if you're also one of the ones that only reaches 3 million, that's not a failure. You still made a couple million bucks.
Not everybody wants to have this crazy big business. Most profitable HVAC businesses are usually in this $5 million, believe it or not, this $3.5 to $6 million revenue range, where you don't necessarily have to have in this sales manager, general manager, some will call them non-revenue generating salaries involved, where the owner can manage most of this and it's controllable. Growth for growth doesn't mean shit, right? There has to be a purpose behind why you want to grow. The other challenge I wanted to bring up here a couple moments ago is, we're talking about these perfect scenarios. What I mean by that is, here's a $3.5 million business that has their books together, that can produce financials when asked for. And oftentimes that's not the case. So I'm giving you a perfect example of a quote unquote $3.5 to $5 million business revenue wise that, hey, when there's financials that are asked for, they're able to go ahead and produce them. Most cannot. When I'm having a conversation with somebody and saying, hey, listen, I need to take a look at this basic minimum financial information to get an idea of where you're at. If the business owner can't produce that, they got some issues. If it takes more than a couple days to produce this basic,
we're just talking about P&L.
It's 5 items, right? That I need to take a look at. A couple questions about the business.
What are the 5 items? Because you mentioned tax return.
You got a P&L, you got balance sheets, you got tax returns. There's a mix of it and a couple other questions that go on. It's challenging.
I want to know the 2 other. P&L, balance sheet.
Can't give away all my secrets, Zachary. I need blood. I need blood type. I need all that good stuff. Just kidding. It's the simple stuff. And if they can't produce that for us in a timely fashion, it's hard to put my arms around and say, hey, come become my client. I can't wait to take you to market. Because the next level, the next steps don't get easier. It's harder.
Right.
My first checklist is 8 items. My next checklist for my client is 54. We're going to do a deep dive. We're going to take the blood work and we're going to spin it and we're going to look at every different thing humanly possible. First one is a cursory glance. I'm going to look at you and say, hey, you look like you're healthy. Right. The next one is we're really going to take a deep dive here. When these guys can't produce, you have to understand, if I'm a buyer and here I am and I want to bid on this business and I'm asking financial questions and it's taking me 2 weeks to get an answer back, how can I give you a top of the market price when you can't produce some of the simple stuff for me? You're not running a business at that point in time. Me as a buyer, oh, I get this. I'm not going to give them that number because they're never going to get that number.
I want to try and be fair and just and balanced in these conversations. Let's talk about whether or not there even is a dirty side. I'm using that probably incorrectly, but what's the downside? Is there anyone that's, stepped into these? I'm sure there are. And if you don't want to talk about it or you don't have any examples, that's great. Or if you don't want to talk about it, then that's fine too. But of people that have been unhappy with their transaction or gotten screwed, what are the negatives? Because all you hear is the positives. Yay, I got my $25 million check and I'm riding off into the sunset. What?
Zach, I wish I could show you the number of texts I've got from people that we've been in contact with that said, did the deal on my own. Shame on me. Should have used you guys.
Why? The why of that is, I think, important. Why?
Because they don't speak private equity. They speak
But why?
HVAC.
Why does that hurt them? I guess is what is the why should you partner with somebody that knows what they're doing? They lost naming rights to their firstborn. What happened?
No, they don't know how to determine their EBITDA. They've never gone through this before. So I'm a HVAC business owner. I know I do 10 million in revenue. Somebody tells me what my EBITDA is. The buyer is telling me what my EBITDA is. That means they are controlling my process. If you didn't bring a professional in to handle the most important deal of your life, it doesn't make any sense to me. Who's telling you what your EBITDA is? How are you determining your EBITDA? Are you understanding the different levels of the dozens and dozens of different types of add backs there are, or the things that can be worked to go ahead and beef up what that EBITDA number is, or there's a time frame in it, or timing to it, or the ability to comp over other months from other years? There is a game within a game. You're asking a business owner, right, that is very well versed in HVAC, most important transaction of their life, which they have never done before and will never do afterwards. I hate to sound cliche and salesy with it. My God, if you needed a lawyer because you had an issue and money wasn't an issue for you, are you representing yourself? Are you hiring the best of the best? Throw anything in there. There's a surgery you have to have. Are you going to go ahead and Google and YouTube how to go ahead and do these things, or have one of your family friends do it? Or are you hiring the best of the best? And there's a reason for that. It's sophisticated. These transactions are sophisticated. Private equity is smart enough to know that most HVAC owners know HVAC and not private equity deals. You have to realize that while you're going to be partnering with these guys, you're not partnered with them until after the transaction is closed. Up until then, you're on the other side of the table. Anything that they don't give you now is more money that they have at the flip. So you got to maximize out where you're at. Man, it's just like these baseball contracts, right? Or these football contracts. Like, take a look at Dak Prescott. He's going to get like a $60 million a year payday. His agent's maximizing out where he's getting. That's the world. You're maximizing out what your value is. And if you are representing yourself, I promise you are not maxing out where you're going to be.
Yeah, that's good advice.
By the way, plus you have to run your business at the same time the transaction is going on. And I'm telling you, even with us involved in the mix, this almost becomes a second job. Handling it on your own, talking to multiple different buyers. If you're so lucky to be able to find multiple buyers and know how to get them all together, it then becomes another 1, 2, 3, 4, potentially 5 other jobs that you're handling on top of running your business. What gets lost in the translation is this. Remember what I said from before. Deals are done on a trailing 12 months. So if a deal is going to take 4 to 6 months, you realize the next 4 to 6 months in front of you are going to affect potentially 50% of your EBITDA. If you are not keeping your eyes on the prize, and now you're so caught up in the deal that you slip on your numbers, you're going to get less money. So what would be the purpose of trying to handle your own transaction?
The psychology is you're trying to be economical. Like a lot of these guys, and I'm just seeing the other side of it, is they've been scrappy their whole lives. They've probably been pinching pennies. They've tried to grow their business. And here's another opportunity. Cut out SF&P, save, whatever the percentage, the fee is. It's not that complicated. Again, I'm just speaking for them. Obviously, it's super complicated, and you're going to save hundreds of thousands of dollars, maybe 7 figures in money. That's probably the psychology, and they can walk with more. But in reality, I'm sure you're right. You're probably leaving more on the table than you're spending.
It's not just that. It's the God knows how many deal points that are negotiated in LOI that set the framework for the deal getting completed. That's part of this too. There's so much that goes involved with it. So let's walk through a simple analogy, right? You get a weird blood result. Sorry to go into the negative stuff, but I think people understand this. At one point in time or another, everybody's had somebody who's been ill in their life. You go get a second opinion, right? Just to confirm what the first one is. Can I tell you how many of these, I talk to these owners, say I got a deal done? I don't know. This one guy called me out of left field. Sounded like a good deal. So they never got a second offer or a third offer on their business. So they trusted in this one scenario. That's a very expensive trust, potentially. Could be millions of dollars worth of a trust. So when we take on a client, Zach, and I take them to market and I have 2, 3, 4, 5, 6, 7 offers in front of them, you think they feel pretty confident of the value of the businesses? They now
Right.
seen 6, 7 offers, and you realize with 6 or 7 offers in front of me, I can start jockeying these back and forth, right? Leveraging them, competitive bidding process for the best outcome for my client. Whether that best outcome is a financial outcome or the best chemistry fit? Because there's two parts of this deal. It's not always the best financial outcome. If I'm going to be in business with you for the next number of years, there's a chemistry fit there as well. Can we match the two of them up, or is one going to be pulled ahead of the other one? What's most important to you? Is the money? Okay, so I could take maybe the offer. I could take the partner that I don't have the best chemistry with, but they're paying the best number, or I need the best chemistry fit. And if it's a little bit less than the number over here, that's okay too. But if you don't know what all those options are, the reason why a lot of these deals blow out, not with us, but when they're handled on their own, is because the owner's on Facebook talking to everybody and then some, and everybody in there is blowing smoke up their ass saying, you should have gotten 14x, 12x, 20x. These numbers don't even exist, by the way.
Yeah, right.
But everybody BS's about it. Like, look how big the fish is that I caught. And then here a buyer is saying, we're closing tomorrow, and this guy's getting cold feet, and the deal collapses. The nice part about when we bring a deal to market is we've got our clients coached up. They know the numbers that are in front of them are going to be the best that they've ever seen. And when we take these deals to market, private equity knows that when we bring a deal to market, we've already all the legwork. Everything's been vetted out already. So they can put their best foot forward.
It adds a seal of approval and a guarantee from both sides. So yeah, it's a no-brainer to me. No question. Just trying to see both sides of it, and doesn't mean it's right.
By the way, and owners can understand this. They go and they bid for either an HVAC fix or a new system, right? Or a replacement, whatever it winds up being. First, like, I'm going to do it on my own.
And then they
Same thing.
Electrocute themselves.
Right. And afterwards they say, God, I should have hired you to do it anyhow because I blew that. Yeah. Same type of thing.
You just caused more damage and cost yourself more money than you would have if you had hired experts in the first place. So yeah, I hear you. Well, awesome, man. It was awesome having you on here. I certainly learned quite a bit about SF&P, understand you guys better. Brian is a great resource. Again, text number right here. Text it.
Anybody that's ever called me, it doesn't matter the size of the business. I talk to everybody. I've been doing this like this for years.
I need to put you in my speed dial. It needs to be Brian Cohen, and company name needs to be Golf.
Yeah, you'd be surprised for as much as I play that I'm really just
terrible.
I can't move off my number. Well, I don't say I'm terrible. I have some moments of brilliance followed by lots of moments of not brilliant. It's fun to get out and socialize with everybody and have a good time. But I'm a resource, man. Like you said, I'm here to help anybody who wants to be helped. We could take a look at some things and give you some guidance and maybe introduce you to one of the affinity groups, or here's a fractional CFO that can help you out. Go talk to some people. You know what I mean?
I grew up in Michigan and through the 80s. How old are you?
53.
Oh, you're 53. Damn, you look good.
I appreciate that.
Yeah, I'm 47, so you got 6 years on me. So you're what, 71?
70.
Okay. You're going to be 54 this year.
Mm-hmm. Very exciting.
Oh, that is very exciting. When's your birthday?
November.
There was this commercial in Michigan. Their brand now is a law firm, and it was like 1-800-CALL-SAM, and the commercial was just literally just call Sam, and then it was one stamp, call Sam. And it's just like a quick backlash to when we had to watch terrestrial TV and watch all the commercials. Horrible. One last question for anybody that actually is watching this and not listening to it. Brian has some really cool artifacts in the background. I'm dying to know what they are over your right shoulder.
It's just, for lack of a better term, decorative wood.
Is there a story behind it?
No. I had an amazing interior designer who really decked this place out nice and modern and brought some of that wood look in throughout the place.
Oh, okay.
I appreciated the time today and the ability to talk through a lot of this. By the way, your questions were incredibly insightful. And I think there are a lot of the same questions that everybody else asks, but maybe are afraid to because they don't always know even the questions to ask. But I think we give a really good, thorough overview for anybody who's contemplating what their next step's going to look like. Yeah,
let's hope. That's the goal of this podcast, is just kind of bring some light into everybody out there. There's a lot of them, 3,500 in Phoenix, Scottsdale. Just understand where they need to be, where they need to go, and how to get there, and some of the resources and the state of the market that exists in terms of buying, selling, and just general succession planning for your contractor business. So thanks, Brian. It was great. You have a wonderful day and a wonderful week, and we will talk soon.
Looking forward to seeing you at the next event.
Thanks, everybody, for listening to another episode of The Boost, and go get them.